Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Vaxart stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vaxart is a biotechnology company. It is focused on the discovery, development, and commercialization of oral vaccines that can be stored and shipped without refrigeration, eliminating the need for needle injection. Its vaccine, called VAST, can be used for inhibiting noroviruses, seasonal influenza, respiratory viruses, and HPV, human papillomavirus. It is currently working with Janssen Pharmaceuticals on a vaccine to fight the flu using proprietary antigens. The purpose of the company's technology is so vaccines can be taken orally by tablet form instead of using needles. In 2019, several hedge funds invested in Vaxart, the largest investment coming from Armistice Capital, which acquired 25 million shares. In April 2020, the company reported positive immune responses in lab animals from its tests with a vaccine candidate for COVID-19. A few months ago in October, the company was under investigation by the SEC and federal prosecutors after the company may have exaggerated its role in Operation Warp Speed. This is the headline for an article dated February 8th. Vaxart had a positive response from its phase 1 trial for its COVID-19 vaccine. Let's get started with the model. This is a small cap company, 970 million market cap. They're trading at $9.51 a share, and they have 109 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they also have negative net income every year. Revenue is a sales for the company, and that's pretty low, between $4 and $10 million a year. This is the company's income statement. The top line is the revenue, the sales. Below that is their operating expenses. This type of company spends a lot of money in R&D, research and development. That's part of operating expenses. Revenue minus operating expenses gives you your operating income, and they have negative operating income every year. Below that is the interest they pay in their debt. Then below that is other income and expenses. This is usually impairments or investments. Below that is their pre-tax income, which is negative every year. Then they have a small amount of taxes, and the bottom line of their income statement is their net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. They don't have much in CapEx. And the way you calculate free cash flow, it's operating cash flow minus CapEx. And they have negative free cash flow every year. In order for the company to run its business, it's been issuing capital stock, 18 million in 2019, 106 million in the trailing 12 months. They haven't been issuing debt. They have been paying down their debt. They paid down $400,000 in 2017, 1.7 million, 3.8 million, then 2.5 million. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. The way you could think about operating cash flow, it's net income converted to cash. And the way you calculate operating cash flow, you start with net income, then you have to add back the non-cash items on the income statement. They had 2.5 million of depreciation. That's a non-cash expense that brings down your net income, but you have to add it back on the CFO section. They also had 4 million in stock-based compensation and 1.5 million in changes in working capital. This is changes in accounts payable, accounts receivable, inventory, things like that. So even though the company reported a $25 million loss, they had negative 17 million of cash flow from their operational business. Let's look at their capital structure. $13 million of equity, $2 million of debt. So they're 85% equity, 15% debt. And their net debt is negative 11 million. So that means they could pay off all the debt with the cash on their balance sheet and still have 11 million left over. Their WACC is 4.7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $6.8 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $5.8 billion. We divide that by 109 million shares. And we get a calculated stock price of $53. They're trading at $10, so they're trading at an 82% discount. It's a really strong buy according to the model. Simply Wall Street is even higher than me. They're at $142 a share. They're saying the stock is 93% undervalued. It's impossible to run a traditional discounted cash flow model on a company that has negative free cash flow each year. So the way I estimated their future free cash flow was based off of analyst estimates and the company's estimates of their future free cash flows based off of the expected success of their future vaccines. Of course, nothing is written in stone. Their vaccines may never work and the company may go bankrupt. That's a risk you need to take when investing in a company like this. So you can see in the past 5 years, the stock was trading over $20 at its peak. Then it kept dropping little by little over the past few years. I think there may have been a short squeeze on this stock. That's why it was driven up so much, but it's come back down. So if you bought down here, you would have been well off, but if you bought up here, you might have to wait a long time to get your money back. This company has a really low beta, 0.28, so the stock moves much less than the market. It's not volatile at all. And the stock has gone up 550% in the past 52 weeks, much better than S&P 500, which went up 16% in the same time frame. The 52-week low was $1, the high was $25. And the stock is trading above its 50-day and 200-day moving average, so it seems to be on an uptrend. This is a really liquid stock. About 70 million shares have been traded on average the past 10 days. And of the 109 million shares outstanding, 98 million are on float. 38% are held by institutions. 40% of the shares on float are shorted. So this is a great opportunity for a short squeeze. If you invested $10,000 into this company 10 years ago, you'd be down to $1,600 today. That's an 84% loss on your investment. RA Capital is the biggest shareholder at 10%, then Vanguard, then BlackRock, RTW Investments, then Care Capital. Let's look at their financial ratios. The average PE in the market's 10, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 137, so investors are paying $137 for $1 revenue. That's a terrible price to sales ratio. Price to book is stock price over book value per share. They're at 80, another really bad ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 13 million of equity, negative 4 million of tangible equity, since they have 17 million of other intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have a negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities almost 2 times. According to their last published balance sheet, they have $13.5 million of cash, $3.5 million of receivables. So the company is undercapitalized. They had negative free cash flow of $17 million. They have $8 million of working capital, so they're short $9 million. But these numbers are from their last annual balance sheet. And they did a capital raise, so they should have enough cash to get through the next year or two before another capital raise. But when a company issues stock to raise capital, it's diluting you, the shareholder. The best way to look at ratios is to compare them to similar companies. I've done videos on Alexion, Exelixis, Insight, Moderna, Regeneron, Royalty Pharma, and Vertex, all in the same industry as Vaxart. And Vaxart is worse in every category when you compare it to the average. They have a negative PE, they have a terrible price to sales, terrible price to book. They do have a good current ratio, terrible ROE. They're doing well in debt, only 15%. It's pretty close to the average. And they're a really tiny company, much smaller than every other company in this industry. Only one of these companies pays a dividend because companies in this industry generally don't have consistent expected revenue streams. So to summarize, I have them trading at an 82% discount. This is assuming their vaccines are successful. That's an assumption. Of course, anything can happen. Nobody can predict the future. And this company has been around since 1969, so they have been around a while. Although I still rank their free cash flows 1 out of 10 because they're negative every year. I rank their revenue 1 out of 10 because it's really small and it doesn't really increase. And I rank their ratios 1 out of 10 because they're pretty terrible. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.